Nearly half of UK adults don't know their credit score, and a quarter have never checked it. But it's free to do so there are no excuses for not knowing it. And I can't stress this enough. If you want to be a homeowner at one point in time, make sure that you know your credit score, because something in the now could impact you badly in the future by you just not taking action. The funny thing is, the biggest thing that the lenders look at isn't even part of your credit score. Still, that being said, it's important to check because criminals are taking out credit worth £1.8 billion a year in other people's names. Stick around to learn more about credit scores and how you can check yours and what it all means. If your friend's brother asks you for £100 and your friend swears that they're a good payer, you'll probably say yes. But if a friendly stranger you meet on the road asks for the same, you'll probably say no. And why is that? It's because you've got no data on them. And banks think the same way. Your past financial reputation matters. And this is why credit scores exist. We all know that money can be the root of all evil. It can even split friends and family. And lenders and bankers know this. So they use data to make sure that the money they lend you does not come between them getting repaid. But here's the thing. Each lender actually uses their own credit scoring system. If you cancel a credit card, one lender might see this as a good thing, as there is less available credit available to you. However, another might see it as a bad because you've got shorter account history, so they can't really dig into the data. And in the UK, there is no uniform rule. Check all 3 credit agencies before you apply to anything big like a mortgage or a loan. The scores that you actually see online, they're just an average guide. Lenders look far more than just that credit score number. So if your score drops by 20 points in 1 month, don't panic. However, if it falls from 900 to 600, it's time to dig in what's going on, because a slight drop is normal, but a big drop is cause for concern. How often should you check your credit score? At a minimum, you should do it once a year. However, month over month is better, and you should always check it before applying to something big, whether it's a credit card, a mortgage, a loan, because even the smallest detail like a wrong address on your credit file could trip you up. Your credit report actually lists quite a lot of details on there, such as loan payments and credit cards you've got out under your name, whether you're on the electoral roll, every phone contract you have, counter court judgments, and it even tracks how many applications you've made for credit. Too many applications in a short period of time can actually hurt your credit score. Even something as small as your job title being different across different applications you've made can actually lead to you being rejected for that loan or credit card or mortgage application. Did you know that the biggest factor that lenders actually look at isn't even in your credit score? You can't find it even if you were to look for it. And that thing is your income. You could have a fantastic credit score, but if your affordability score is low, then you will get rejected for that loan or credit. So you could apply for a loan that was £3,000 and get approved, but if you apply for a loan that's £10,000, you will get rejected. Even though the credit score is the same, it's your income that's having an impact on this. The higher 10k loan just does not work for them on the affordability score that they've got for you. So why is income so important to lenders? They actually look at 3 things with your income. The first thing is the debt ratio. This is the total value of your unsecured debt as a percentage of your total income annually. They view anything under 25% as good and over 60% as bad. And oddly, even under 1 or 2% can even be bad. How can you improve this ratio for yourself? You either earn more or you pay off your debts earlier. The second thing that they look at is the credit utilization. This is the total percentage of credit you have available to you and what you're actually using. Again, under 20% is excellent, 20 to 40% is good, 40 to 60% is okay, and anything over 60% is bad. So how do you improve the credit utilization? Similar to the other one, you can pay down your debt earlier, or the second way is actually apply for more credit. So get out another credit card and don't use that line of credit. So the credit utilization ratio actually drops in your favor, and all you did was just apply for more credit. So the third thing that they look at is your disposable income, how much you have left over after you've paid out all of your outgoings. This one is super important, and for mortgages, they'll actually request 3 to 6 months worth of bank statements so that they can assess and go through line by line. So the biggest tip here is, if you're applying for a mortgage, be super frugal for the 6 months leading to you applying for the mortgage, because it'll increase your chances of you actually being approved for the mortgage. Cancel that gym membership to lower your monthly outgoings. Is your phone coming up for renewal? Don't renew it yet. Is your lease coming up for renewal on your car? See if you can extend it for the same amount of payments, or even better, cancel it. Cut back on those Starbucks coffees that you get in the morning. I know that's going to be hard, but the aim here is to reduce your spending so that when they look at the bank statements line by line, they don't pick you out on anything. change. For loans, it's actually a bit different. They actually just use the income and place it in one of their models to estimate the average person on that income, how much disposable income they'd have left over. So if you went frugal for the 6 months leading up to your loan application, it's not actually going to make that much of a difference. So hopefully you understand how the banks see you and see your credit scores and see your income, and how you can actually try and play the system in your favour. One thing to note is that credit scores aren't a level playing field. The rich and the poor don't even play in the same field. They probably don't even play the same sport, to be honest. And to finish off this discussion of credit scores, what actually happens if you go completely bankrupt and ruin your credit score? Well, it's not the end of the world forever. Credit companies actually keep a credit history of 6 years. So after 6 years, that will actually drop off your credit score. However, the lenders can still ask if you've been bankrupt, even way past 6 years. And you lying on the application could be seen as fraud. So even if it's not on your credit score, if they ask you the question, have you been bankrupt, you have to say yes. Otherwise, you're committing financial fraud. The sooner you start to look into your credit score, the better chance you have to make sure that your credit file stays strong and healthy. So make sure to check yours today. It's completely free and it could save you thousands down the line. No, genuinely thousands, because the interest rates that good credit score people have over ones that don't have good credit scores will pay much less interest over their lifetime. In the description, I'll link the 3 credit agencies that I've used in the past, but I also recommend you using. And if you found this video useful, make sure to like and subscribe to this channel. I talk about easy and casual personal finance tips and tricks because I believe money in any way, debt or assets, should always work for you, not against you. Thanks for tuning in this week. See you later.